Hello everyone, this is CA Isha Agarwal and today we are going to learn about essay 210. This essay is very important to the auditor as he starts with the audit. Also a very short and simpler essay that can fetch you good marks. Further, what are the components of engagement letter, who sends the engagement letter, what are the objectives of this essay, what are the situations under which engagement letter can be changed, what are the situations that the engagement letter can be revised? What are the situations under which the auditor withdraws or does not accept the engagement? All of this we learn as we progress in this essay. Also, if you're watching this video just before the exams, it is advisable that you watch this video at 1.5x so that it could save you some time and also be a good source of quick revision. So, okay, before we start this chapter, a few points that we need to understand. So, always remember audit is a kind of contract. Contract between whom? Client and the auditor, wherein the client allots work to the auditor, gives him the task of cleaning his financial statements, of making sure that his financial statements are free from material misstatements, of ensuring that his financial statements are reliable, and auditor being the contractee is supposed to do that work. Now, whenever there is a contract, there has to be an agreement. फॉर एग्जाम्पल अब आपके घर पे पेंटिंग हो रही है, जैसे ही पेंटर आता है तो आपके घर वाले उनको काम में अलॉट करते हैं कि आपको ये 6 वॉल्स पेंट करना है. आपने अलॉट कर दिया कि चलो ये 6 वॉल्स पेंट करना है. अब ये तो एक ओरल अग्रीमेंट हो गया. 4 दिन बाद जब आप उनको बोलोगे कि आपने 7वां वॉल क्यों नहीं पेंट किया, तो वो फटक से क्या रेफरेंस देंगे, आपने तो मुझे बोला था 6 वॉल पेंट करना है. या फिर 4 दिन बाद आप उनसे क्वेश्चन करोगे ये 5th वॉल क्यों नहीं पेंट हुआ, तो वो क्या आप भी वो क्या बोलेगा कि आपने तो 6 वॉल बोला था, मैंने 4 किया, मैंने 2 और करना है. नाउ व्हाई कुड यू मेक दिस क्वेश्चन और व्हाई could he defend himself with the 6 walls? Why? Because there was an oral agreement. You can't ask more and you can't take less because there's an agreement defined. Be it an oral agreement, but the agreement was defined. So what help did the agreement do? Two helps. First, it helped you to resolve future disputes. That is, once you started speaking about the 7th wall, he had the solution, that he had the agreement and he could defend himself with the 6th wall thing. And next, the scope of work was defined. So even he can't say that after 4th wall he won't paint because the scope of work was clearly defined in the agreement, in the oral agreement. So what help does the agreement do? It helps you to resolve future disputes. Also, it helps you to ensure that the scope of work is defined. So in audit, all of this agreement is known as an engagement letter, which the auditor sends to the management, and once the management reads it, and ensures that they are okay with it, discusses with the auditor, and then agrees and signs it. Always remember, for the agreement to be a valid agreement, both the parties need to agree. Auditor सिर्फ अपनी बातें सब लिख के engagement letter दे देगा and he thinks that it's a valid agreement. No. The management needs to agree to it, and if the management is not agreeing and discusses something with the auditor which the auditor is not comfortable with, he can choose any further action if he wants, but that agreement won't be a valid agreement. So now that you have understood that the agreement is needed and which is called an engagement letter in audit, we'll start. What are the objectives of this essay? So basic two objectives of this essay are to ensure whether the preconditions of the audit are present, and next, to ensure that there is a common understanding between management or TCWG and auditor regarding the terms of engagement. So first we'll take up point 2, that is to ensure that there is an understanding between management and auditor regarding the terms of engagement. As I said, an agreement is a valid agreement only when it is agreed upon by both the parties. So second objective basically says that to ensure that the engagement letter has been agreed upon and then only the auditor proceeds. Because if he thinks that he has simply sent the engagement letter and can continue with the audit, no, that's not the situation. He has to ensure that the management agrees to it, management understands it, discusses with the auditor. If he has some issues, he can discuss with the auditor and then agree upon it. Simply non-agreement of the management or simply a blank response from the management won't help the auditor regarding the engagement letter. Now coming to the first point, to ensure that the preconditions of audit present. But ये preconditions क्या होते हैं अब? तो अब सपोज हमने डिसाइड किया कि हमें ऑडिट करनी है, अब कल से उनके पास ऑन साइट चल जाओगे और उनके काम करना स्टार्ट कर दोगे? इज इट पॉसिबल without any data or without any stuff? Is it possible for you? No, it isn't possible. Why? Because what will you work upon? Or if you have to do any planning, what will you do if you don't have even a draft financial statements? If you don't float your requirements, or even if they don't have the basic data ready, what will you work upon? So as you must have seen, before going to any audit, we plan the audit, we send the primary requirements to the client, and once the basic data or the basic requirements of the clients are ready, they send us through mail or inform us over a telephonic conversation that the basic requirements are ready, and then you can start with on-site. Because you can't simply go next day to the client and say चलो ये data निकालो. Obviously the client has to spare time for the auditor, पर ऐसा नहीं है कि वो आपका सारा काम छोड़ के आपके लिए बैठ जाएगा, and you need to understand this. So it is always ensured that once the planning is done, basic requirements are available, and then only the audit starts. So the objective of preconditions basically means that you have to ensure that the pre-requirements of the audit are present. Now, what are the pre-requirements or the preconditions of audit? So basically, there are 4 to 5 preconditions that we need to remember. First is that management acknowledges and understands the purpose and the responsibility of preparation of financial statements as per financial reporting framework. That is, as I said, अगर आपके पास financial statements ही नहीं होगा तो आप planning किस पे करोगे, आप materiality किस पे calculate करोगे, आप कैसे सोचोगे किस पे क्या time allot करना है. In the last essay 200, we discussed that the auditor should ensure that he spends time or he allots time to each item of the financial statement, be it less or more. But how will he decide so? आप इम्प्रॉम्प्टू उसके पास नहीं जाके सोच सकते कि मैं एसेट को 10 घंटा दूंगा या मैं लाइबिलिटीज को 20 घंटे दूंगी या मैं एक्सपेंस को सिर्फ 2 घंटे दूंगा. नो, यू कांट डू दैट इम्प्रॉम्प्टू विदाउट अंडरस्टैंडिंग द फाइनेंशियल स्टेटमेंट्स ऑफ द कंपनी, बिकॉज फाइनेंशियल स्टेटमेंट्स ऑफ द कंपनी may differ from some other company. Once you have applied a planning procedure to one kind of the company, you can't apply to the same planning procedure to the other kind of company. Because the financial statements of the company में differ. किसी की liabilities ज़्यादा हो सकती है, किसी के assets ज़्यादा हो सकते हैं. कहीं पे there is a situation wherein कि आपके assets में ज़्यादा कुछ classification है, wherein कहीं पे situation होगी liabilities में ज़्यादा classification है, कहीं पे situations है कि income तो कम है पर expenses ज़्यादा है, कहीं पे situation है कि income ही income है, expense बहुत कम है. So all of the audit procedures would vary upon the financial statements. So it is very important to ensure that management acknowledges and understands the responsibility of preparing the financial statements, because if the financial statements are not prepared by the management, or if he misunderstands the scope that auditor will prepare the financial statements, the auditor cannot work. The auditor cannot work if the management has not prepared my financial statements. Further, the financial statements should be prepared as per financial reporting framework, that is, as per the applicable AS or Ind AS on the company. ऐसा नहीं है कि उन्होंने financial statements वो T form में बना के दे दी and आपने पढ़ ली. No. They should be, even if there are draft financial statements, they should be prepared as per financial reporting framework or as per Schedule 3. It is very important that the financial statements are prepared nicely for you to apply your audit procedure. Also, once you apply your audit procedures, detect your audit findings, convey it to the management. They should be responsible for changing the financial statements too. They should not think that the auditor once found the audit evidence will change the financial statements. Because the maker and checker cannot be same. The auditor has checked the financial statements, but the management is responsible for making it. So always ensure that management acknowledges the responsibility of making financial statements. Next point, parallel to making financial statements, is that management acknowledges the responsibility for creation of internal controls relevant to financial statements or financial reporting. That is, all the controls that are required to bring up to the financial statements, that is, internal controls basically serve as a base to the pyramid. If the base to the pyramid is not correct, the pyramid won't stand. So the management has to ensure that every brick of the pyramid is controlled by them and is ensured that everything is in control. Because once the management ensures that every control is in place, they can make the financial statements very easily. But if they do not have the controls, it is very difficult to make the financial statements. For someday tomorrow, if the auditor brings up that there are weak internal controls in this area, or the internal controls need to be devised correctly, or they are not efficiently performing, who will he convey it to? To the management, who is ultimately responsible for creation of internal controls. So management has to ensure financial statements are being prepared nicely, plus the internal controls are effective, running and created nicely, so that the financial statements can be prepared nicely. So both these points are concurrent. First, if you make the internal controls correct, your financial statements are correct, and if you make the financial statements are correct, you can automatically ensure that your internal controls are correct. Third, the management should provide auditor with access to all information that management is aware of and is relevant to financial reporting. Now, management may use many types of data to compile the financial statements. All of these data should be provided to the auditor to check them to go to the financial statements. From directly financial statements, auditor cannot do the reverse mechanism and understand that from where does the data come, or from where should I get it, or from where should I ask the client. No, he should be provided with all the base data so that even he can understand from where does the financial statement item comes from. For example, let's take the example of purchase register. So the purchases of the company and the purchase register when should be matched. Also, when the financial statements are provided, the purchase register should be provided with that itself, so that the auditor does not need to ask again and again the base data of the financial statements. That is, if he has the purchase register available in hand, even he won't ask the client again and again where did the purchase come from. He can obviously check the purchase register, find out the problems, what need to be improvised. All of this can be communicated to the client, but only if he gets the purchase register. For example, if the auditor is just left with the financial statements and has no clue that how did the client get the purchase register purchases, and how would he check the purchases? What would be the scenario? What will he check with just the amount of purchases? For suppose the amount of purchases is 100 crores, but how would he check that? Obviously, he needs to get the base data to check that how did the client arrive to that amount of purchases. So it is very important for the client to provide the base data and access of all these informations to the auditor to ensure smooth functioning of audit. And lastly, to provide auditor unrestricted access to all the persons or parts of the entity wherein the auditor can gain audit evidence. That is, the management should ensure that the auditor does not have a restricted access. That is, management should ensure that it is not a limitation on the auditor that okay, he cannot meet this person, he cannot meet this person, he cannot access that data, or he cannot access that part of the company. No, he would get the audit evidence of the company, of the financial statements, only by meeting people, understanding the processes, and then by understanding the flaw. If you want the financial statements of the company to be absolutely correct, you have to allow auditor some space, some access to work. If you put a limitation on the auditor, you yourself want the auditor to not complete the audit nicely, effectively, and efficiently. Because placing limitations to the auditor regarding all of this would ultimately hamper his work quality itself, and which would ultimately make you lose the quality only because the auditor won't be able to deliver value to you. So it is very important for the management to provide unrestricted access to the auditor from for all the areas wherein he can obtain his audit evidence. So be it maybe the stores manager, or maybe the purchase manager, maybe the sales manager, maybe the financial accounting person. All of the persons should be introduced, and the auditor should be given a free hand to go and talk to them, so that even the auditor can suggest the improvisations in the company, even if there are no flaws. This would ultimately help the company up their game only, and in any way not harm the company unless the company is involved in any fraud or wrongdoing. So these were basically the preconditions of audit that the auditor should ensure before starting their audit. Now that we have understood the objectives of this essay, we'll further move what is contained in the engagement letter, that is the agreement. So basically, first thing first, scope of work of the audit and the auditor. As I said in the painter story also, scope of work needs to be defined. Next, responsibilities of both management and auditor needs to be provided to ensure that there is no confusion in the future regarding the work to be done by management and to be done by auditor, and also there is no future disputes regarding this, wherein the management will ask the auditor to do that or the auditor will ask the management to do that. Also, this basically clearly helps the auditor and the management understand their scope of work and their scope of responsibility, and thereby create avoiding a sense of misunderstanding in both of their minds. For suppose the management will not misunderstand that the auditor will do the legal work also, or the cost accountant's work also, or the chartered company secretary works also. All of the situations will be avoided. Also, the auditor won't over expect from the management also that the management will do this also, do that also, provide me with this data, provide me with that data. They would do the workings for me also. No, the responsibilities are defined. You can clearly read and demarcate it, and the plan should be made accordingly, both for the management and the auditor. Next is the applicable financial reporting framework on the basis of which financial statements are made. That is whatever AS or Ind AS that is applicable to the company, whatever the Schedule 3 points that are applicable to the company should be known to both, because auditor, he needs to know because he needs to check the financial statements that they are as per financial reporting framework, and management needs to know because they have to prepare the financial statements as per the financial reporting framework. And lastly comes the nature and the context of the opinion that would be issued by the auditor, and the situations in which they would differentiate, that is the opinion that the auditor would issue, what would be the form and context of that opinion. That is wherein he is issuing an unqualified opinion, he wouldn't be stating the reasons that why the auditor is issuing an unqualified opinion, because unqualified opinion simply means that the financial statements are showing a true and fair view. So just stating that the financial statements are true and fair view would be enough, wherein if he issues the adverse kinds of opinion or modified opinion, he have to state the reasons why he has been issuing such kinds of opinion, or in case of disclaimer of opinion, he'll have to state that what if the data was not available, or what if the access or limitations that were what if the access limitation that was placed on him, so that he could not do his audit procedures, thereby leading to a disclaimer of opinion. So in case of modified opinions or adverse opinion or disclaimer of opinion, the reasons would be stated, whereas the context and form of the unqualified opinion would be different, but all of this would be provided in the engagement letter. So yeah, he basically provides the form and context of unqualified opinion, and thereby provides the situations where it may differentiate, that is wherein the modified opinion, adverse opinion, or disclaimer of opinion is issued. Now we have basically covered 70% of the essay. The rest left is just 30%. Now what is left in the 30%? So 30% basically contains situations wherein the auditor would not accept the engagement, or wherein the auditor will withdraw from the engagement. Now you need to understand the difference between both of them. In the first situation, the auditor does not accept the engagement, so he does not need to inform anyone. Why? Because the agreement didn't go forward only. He did not file anything with any government authority. He did not inform anyone that he is accepting the engagement with the client. He did not inform or he did not plan also his audit because the agreement did not go forward only. So in this situation, the client is like he spent around a week or so or maybe a month or so with the client but does not engage in a long term engagement, so there is no such loss of time and effort both, wherein he does not accept the engagement. Whereas in situations where he withdraws from the engagement, apart from time and effort loss, there is also a thing that he needs to inform the same to the reporting authorities, because once he has accepted, when he had accepted the engagement, he would have filed forms, informed the authorities. Obviously, there would be some people also who would have known that he is engaged with the client. He has to inform the TCWG and everything, because once he had started the engagement, he had informed everyone, he had communicated it to everybody, he had started all of this. So, yeah, in case of withdrawal, the procedures are a bit lengthy and the procedures are a bit more rather than just not accepting the engagement. Because just not accepting the engagement basically means, okay, a good example of this could be you met someone but you could not gather a conversation with them. You met 5 minutes, you left, that person becomes as unknown to you as he was the other day. But you meet someone continuously for 2 months and suddenly you think that the person is not correct and you withdraw from it. The person won't be unknown. There would be the friends, the family who would have known him. So you have to inform all of them that you are not currently interested in person, or you are not wanting to get engaged with that person, or you are not communicating with the person. So yeah, this is the example of withdrawing from the engagement and not accepting the engagement. Now, first we'll discuss the situations where auditor does not accept the engagement. So basically, there are three situations where the auditor would not accept the engagement. First, if the financial statements are not prepared as per applicable FRF, if the financial statements itself are not prepared, on what basis would the auditor work, or how would he work if the financial statements itself are not prepared, or if the management thinks the auditor would prepare that. Again, it's a loss for the auditor only. Why would the auditor engage in something like this? Next, if the management does not agree to the terms of engagement, if the management itself does not agree to whatever the engagement letter states, or if the management and auditor do not are not able to discuss their possibilities, their outcomes, and if the management feels that either the auditor should do more, or if the auditor feels that the responsibilities of management are not clearly defined, or if the management feels that the scope of audit is not clearly defined. Any situation probable. In all this situation, if the management does not accept the terms engagement letter, the auditor cannot go forward without it, because as I said, agreement को agree करना पड़ता है दोनों parties को before moving forward. And lastly, if the auditor places a limitation on the scope of if the auditor places a limitation on the scope of engagement of the auditor, that is, he says, मैं आपका एंगेजमेंट लेटर एक्सेप्ट करता हूँ बट आप इस एरिया पे नहीं काम करोगे, या फिर मैं आपका एंगेजमेंट लेटर एक्सेप्ट करता हूँ पर मैं आपको 10 लोगों से बात नहीं करने दूंगा, मैं आपका एंगेजमेंट लेटर एक्सेप्ट करता हूँ पर मैं आपको वाउचर्स नहीं एक्सेस करने दूंगा, ये सब के बाद ऑडिटर कैसे ऑडिट करेगा? So in all of the three situations, it is a problem. It is problematic for auditor only because he won't be able to execute his work properly. So why would he engage in such an audit wherein he wouldn't be able to deliver value only? So it is very important to understand in all the three situations, it is very hard for the auditor to deliver his work also. So in all the three situations, the auditor won't accept the audit, and thereby no further procedure would be followed, because if the engagement letter itself is not accepted or is not agreed upon by both the parties, no further procedures are to be taken upon. Now that we have understood the situations under which the auditor may restrain from accepting the engagement or does not accept the engagement. Now we'll understand the situations under which the auditor can withdraw from the engagement. Now, one such possibility wherein the auditor can withdraw from engagement is change in the terms of engagement. Now, change in terms of engagement has basically two parts to it. The first part, wherein the change is unjustifiable. That is, whenever the client proposes a change in the engagement, the auditor should ensure that the change is for a justifiable reason. That is, the change needs to be made in the terms of engagement because there is a change in the company also, or if there is a change in the management also, or the change is such that it is required to change the terms of engagement. That is, there could be a change in any circumstance, or if there could be any change in if there could be any misunderstanding with the management regarding the scope of audit. That is, even after the scope of audit was defined, the management feels that the auditor will have to do the actuarial work also, or the auditor will check each controls of the company also. Yes, the auditor has to issue that the controls are working effectively, but his job is not to ensure that each of the controls are made properly or are devised properly, because that's the work of an internal auditor. Or if the management expects that the auditor will check the cost statements also, because that's the work of a cost auditor. So in all the situations that the management had a misunderstanding regarding the scope of work of auditor, or if for suppose a change in circumstance could be a change in the company segments. That is, the company has recently introduced a segment or maybe have removed a segment. So they want the auditor to change the engagement letter accordingly, wherein his scope of work would change and would either include that segment or remove a segment from his terms of engagement. Now, these situations are justifiable. That there is a possibility that these situations could happen, and these situations do not appear to be fraudulent also. So, in these situations, the auditor can understand the terms of engagement and accordingly change the engagement letter. There is no problem in such situations. However, there are situations where the management wants the auditor to change the assurance level from reasonable assurance to limited assurance. That is, from audit to review. Now, in this also, there could be situations that are justifiable. For example, if the management wanted the auditor to do the whole of the tax audit, but now the management gets to know that maybe the tax audit is not applicable to me only. So the management will go for just tax return filing by the auditor. So herein he changes the assurance engagement from reasonable assurance to limited assurance. But if the auditor ensures that this change is justifiable and the change is actually to be needed and it is okay, so he can create a changed agreement. But in this situation, he has to create a new agreement engagement letter altogether, wherein he would ensure that there is no wherein he will ensure that there is no reference to the original engagement letter and a particular new engagement letter is made. Now, these were the situations which are acceptable by the auditor and which are reasonable too. Now, the situations which are unreasonable, which may cause the auditor to withdraw from the engagement. One such situation could be a sudden limitation on the scope of work of auditor, or a change from reasonable assurance to limited assurance due to certain frauds in the company. For suppose situations like this could be suddenly the management doesn't want the auditor to check the sales area. Suddenly the auditor, or suddenly the management asks the auditor to change the engagement from reasonable assurance to review limited assurance, because the auditor has been detecting a lot of misstatements. Now this creates a doubt in the mind of auditor, because he has seen that the company has been regularly involved in some suspicious transactions in the financial year, or if he has detected a lot of material misstatements. So he is not sure whether the company is actually doing it justifiably or just to protect themselves from the fraud or fraudulent thing or the wrongdoings. And when the auditor is unable to get any justifiable explanation behind it, the auditor can withdraw from the engagement. Because doing an audit of it, doing an audit wherein he accepts the change engagement letter, which ultimately would hamper his quality, would not be able to deliver proper value to the stakeholders, also proper picture to the stakeholders, also just to ensure that the client stays and the client is retained. He would do something which would not help him gain trust of the stakeholders, also he should not engage in such a transaction. So herein he has the option to withdraw from the engagement. Also, as I said, withdrawal would include uh, practically or contractually whatever his obligations are, communicating to management, TCWG, and if there are any government authorities that needs to be communicated to, all of them should be communicated, and he can withdraw from the engagement wherever the whatever the law and regulations whatever are prescribed according to that. So withdrawal may you'll have to remember 2 points, that he can withdraw from the engagement as per the legal laws and regulation, and next, as per practical or contractual obligation, he'll have to communicate the same to the management, TCWG, and other government authorities. Now that we are done with terms of engagement, understanding what is the scope, what is the objective of this essay, what are the changes, how can the auditor withdraw from the engagement, or how can the auditor not accept the terms of engagement. Now we'll quickly understand what are the situations under which the engagement letter needs to be revised. That is, as we all know, auditor is generally appointed for a period of 5 years. So it is so that generally the auditor does not issue an engagement letter in each year, because the engagement letter issued in first year is enough for the 5 years if probably nothing changes. But we'll quickly understand what are the situations under which the engagement letter can be changed or can be revised in the 5 years or in the recurring audit period. First situation comes if there is a significant change in the ownership of the company. Next situation comes if there is a change in the financial reporting framework that is applicable to the company. Next, if there is a change in the any laws or regulations of the company. If there is a change in the nature, size, or context of the nature or size of the entity. If there was any misunderstanding regarding the scope of audit of the regarding the scope of auditor earlier in the earlier audits, so that needs to be revised. Or if there are any revised terms of engagement, that is suddenly if the if the company has engaged in certain maybe related or if the company has suddenly bought a subsidiary, or if the company has entered into a joint venture with someone. So in this situation, the terms of engagement needs to be revised. Also, there could be situations wherein the auditor has to ensure, wherein the auditor sees that there is a change in the reporting requirements. That is, we recently saw a Schedule 3 amendment. So in when the Schedule 3 amendment happened, the auditor had to change the terms engagement letter, because earlier reporting requirements and after post amendment of Schedule 3 requirements was deferred, because earlier so much disclosures were not required, wherein in the amended Schedule 3, better and for better presentation of financial statements, more disclosures were required. So in such situations, the auditor had to have to change the engagement letter. So these were basically the situations wherein the auditor can change the engagement letter in the recurring audits. Thank you. Hope I could explain you essay 210. And once again, if you are watching it just before the exams, watch it at 1.5x. I hope it is understandable even at 1.5x. And yeah, thank you.